In this video, we want to review some assets that we looked at a little bit earlier, and we want to try to compare risk and return, see what this is trying to tell us. We have something that's referred to as the risk return trade-off. Essentially, it says as risk increases, required returns should increase. So as risk increases, investors expect to get paid more. So if we look here, high tech has a 9.9%. It has the highest return. But if you also look over here, it also has the highest risk level. So that seems to make sense. The two assets in the middle here there seems to be something out of place. Collections has the lowest rate of return, and it has a 11.2% risk level. U.S. Rubber has 7.3, it's at 18%, and the market is at 8% and has 15% risk level. So again, these things they just kind of give us something to think about, right? For some reason, they don't exactly seem to be lining up with what we would expect from risk-return kinds of relationships. And if you look here then at the coefficient of variation, you notice again, we have them ranked differently, right? Rubber and collections are at the end rather than in the middle like they were when we were looking at standard deviation. So the idea here is the coefficient of variation allows us to review and make comparisons of different kinds of assets in a relative perspective, if you will. The Sharpe ratio, I mentioned it a little bit earlier, is just the return minus the risk-free rate divided by the standard deviation. And if you look, it tells us that the high tech is 0.34, Sharpe is 0.29, Rubber's 2.29, the market is at 0.329, collections have a negative number. They're performing less than what you would expect even on a risk-free basis. And of course, the Sharpe ratio of T-bills is 0. Now, if we're thinking about comparisons, the stock market is considered the average. So you want to perform better than the stock market. Well, the high-tech Sharpe ratio is on a risk-adjusted basis, because it has risk in it, is performing better than what the stock market is performing. So that might be an asset that we would consider purchasing. So let's talk a little bit more about risk, right? There are typically three ways we think about risk. Investors can be what we refer to as risk neutral. That is, they really don't consider risk at all, right? They look at the benefit of buying the investment, which is a return, and then they don't care how risky it is. Risk seeking implies a gambling kind of activity, that investors, for higher risk, they have lower expectations of returns. In fact, if you think about gambling, the idea of gambling statistically is you're supposed to lose your money. If you weren't supposed to lose your money, they would call it investing. Now, risk averse is what we assume managers and investors should be thinking about. This is how they should manage their decision making. So risk averse says that as risk increases, investors want a higher rate of return to get compensated for that. Now, the risk premium is the difference between a return on a risky asset and a risk-less asset. This is what serves as compensation. So I think if we only had two things that you could buy, you could either buy a United States Treasury bond or you could buy a stock. On average, what's the difference in returns between those two things? You could buy risk-free or you could buy risky. The risk premium is the difference between those two things. So let's switch gears now and talk a little bit about portfolios. An investment portfolio is just a collection of financial assets. We also mentioned a corporation, in one sense, is a combination or a collection of assets. If we assume that all investors are rational, that means they're all going to be risk averse. They'll always choose to invest in portfolios rather than single assets. And again, I'm sure you've heard the phrase, putting all your eggs in one basket. You don't want to do that. You want to spread things out to minimize the risk that you take. So a portfolio's expected return is a weighted average of the returns. But its standard deviation is a little more tricky, right? It requires this new probability distribution to be calculated with a different formula. So it's not strictly an average, a weighted average. It has some interaction, if you will. So let's see how these formulas work. To find the rate of return on the portfolio, you take the weights of the assets, what proportion of your money is invested in the asset, multiply it by its expected return. Then you add those all up. So let's look at this, how you do it for weights. We had a previous example. The shares started at 73 and 92. They ended up at 106 and 88. What were the weights at the portfolio at the beginning and at the end? Well, 200 shares times 7310 is 14,620. 200 times 9227 is 18,454. So our total investment started out at $33,000 odd dollars. What are the weights? 14,620 divided by 33,074 is 44.2%. Now, when the prices changed, the weights changed. So now it ended up that asset A, which is the Microsoft, is now 56% of the portfolio, and P&G, the other part, is now 43% of the portfolio. So if we put this again into some context with our portfolios, if you put half of your money in asset A and half of your money in asset B, the spreadsheet does a calculation for you and tells you what your returns are. So the expected return is the average. It's going to be somewhere between those two numbers, 9.9, 1.5. It's 5.53% is the return you would expect from this portfolio. What about its standard deviation, though? 20% is the risk asset, is the risk in asset A. 11% is the risk in asset B. But the portfolio has 4.62. It has less risk than either one of the individual assets. What's going on here is a concept called diversification. It's the reduction of risk by combining things that are not twins. If you look at the coefficient of variation, it also confirms this, that the coefficient of variation of the portfolio is less than either one of the assets in the portfolio. And here we're just talking a little bit more about that, right? So this portfolio provides an average rate of return, but it provides less risk. Again, this is what we want. We want portfolios to be created so that we can earn a rate of return, whatever that is, but at a lower rate of return than the assets that are within the portfolio. If you look for the average of the stock in this example, it's around 35% is the average rate of return for the average stock. So most stocks are positively correlated, not perfect, positively correlated with the stock market. So they have a correlation between 0 and 1. If you combine stocks in a portfolio, generally, you are going to reduce the risk of that portfolio. Now, we're not going to get into a lot of formulas about how we actually calculate this. Just suffice to say that correlation is what drives diversification. Standard deviation of a portfolio decreases as you add stocks. Why? Because they are not perfect twins. Now, the expected return is whatever that is, right? It's the weight times the return. So eventually, if we're diversifying our assets, somewhere around 40 stocks, we're going to end up with a fairly low rate of risk level, and it tends to converge around 20% of any 40 stocks you pick will be the lowest risk you can achieve. Again, this is all about the concept of diversification. Again, to reduce risk, we want to combine assets that have a less than perfect correlation. We want lower correlations. If we could find negative correlations, that would increase diversification even more. Now, if we want to look at this graphically, what we can see is that a single asset has a portfolio risk of around 35% odd. As you add more stocks, you see that the portfolio risk naturally declines to almost a flat line. So what is this thing that's disappearing? The thing that's disappearing is what we refer to as the company-specific or the firm-specific risk of the asset. The thing that we're left with is what's referred to as the market risk of the asset. So in general, you can eliminate risk to a certain point, but at that point, you cannot eliminate any more. That is, again, what's referred to as the market risk. And again, I don't want to get into a lot of detail. This is a very complex concept. So let's just suffice to say, if we can create a portfolio, a big enough portfolio, textbook mentions around 40 stocks. If you randomly pick 40 stocks, you will reduce the risk about as low as you can get with those 40 stocks. So the picture we've just been describing is standalone risk that's the risk of the portfolio, has two parts. Market risk is the part that you cannot get rid of. Diversifiable risk is the part that's eliminated. Now, since I can eliminate risk, and I would always like to get rid of risk if I could, standalone risk is measured by standard deviation. So that's not sufficient to measure the risk of a portfolio if it is well diversified. So we need something to measure this market risk. Thankfully, we have a statistic that's called beta. And again, we'll talk about this in a lot of detail in some later videos. So what happens if you fail to diversify? you can choose a one stock portfolio. Now, does that mean you don't earn a rate of return? In fact, the answer is you could earn a great rate of return if you pick just one stock and it's the right stock. The challenge with this, though, is you are taking on the risk level, you are taking on the standalone risk. And as we've just illustrated, the standalone risk has two parts. The diversifiable risk is risk that you won't get paid for. The stock market will not pay you the rate of return that you need for the amount of risk that you're taking if you could easily get rid of it. So there's no compensation earned for holding this unnecessary risk. Market risk is the only risk that you get compensated for. So does failure to diversify just says you're taking more risk than you're actually getting paid for. So that's a little description about how portfolios work. In later videos, we'll talk about how we actually calculate some of these statistics for portfolio. Look forward to seeing you soon.